So yeah, my name is Robert. I'm on behalf of Blockchain at Michigan here. I'm also the least important guy on this stage because I'm, obviously accompanied by some kick-ass, thought leaders in the space. So before I kind of start here, though, I want to, say thanks to Alexi and Cameron from BAF for setting this up. This was incredibly nice of them to host. And yeah, without further ado, I'm going to hand it off to Jacob. Let's do some introductions and then maybe like a quick 2-minute liner on what the fund or firm is that you guys represent.
Sure thing. Hey guys, Jacob Phillips. I'm a researcher at Polychain. For Polychain, I was finishing up school at Case Western in Cleveland. There I kind of thought I was going to be a stock researcher. Did a couple summers in banking to prepare me for that, and then decided to try and pivot into VC. And one thing led to another, and I ended up at a startup accelerator that was focused on blockchain, which then got me hooked on crypto. I entered for a couple different crypto funds, and then came out to work for Polychain. And at Polychain, I kind of work across the liquid and venture portfolio. Polychain is one of the older funds in the space. And sort of larger. And I think we have a lot of flexibility on deal sizes we do, everything from like incubating companies up to really big OTC deals after projects launch. So we have a lot of flexibility, and yeah, it's been a lot of fun working for them out there. And yeah, I think I'll pass it on to Alex then.
Yeah, again, thank you guys for having me. My name's Alex. I am a research analyst at Arca Funds. A little bit about myself. I graduated this year from Whitman College. Similar to Jacob, thought I would end up in investment banking of some sorts. Always knew I really wanted to be on the buy side, so fell down the crypto rabbit hole and thought this was a really interesting opportunity. So yeah, that's my background. In terms of Arca, so we are a digital assets hedge fund that is really more or less a special situations fund. So kind of a little background on that. We will do anything from activist investing, distressed investing, arbitrage in a way, and then really just fundamentally driven analysis. So yeah, pass it on to Paul.
Hey guys, thanks for having me. I'm Paul Burlage, an analyst, research analyst at Delphi Digital. We're a research consulting shop. And we also have an internal fund that we make investments out of. And we consult for primarily crypto projects to help design their econ. And on the research end, most of our clients are hedge funds.
Yeah, fantastic. And just to kind of sum that up a little bit, Polychain is one of the largest, if not largest, fund in the space, and then Delphi is and Arca are incredibly well known in the crypto community. And yeah, so sort of to kind of move on from that, I thought it would be a really good idea to sort of begin on what do you guys think would be a really what do you guys see as the trajectory for DeFi, more specifically in terms of categories? Do you think lending is going to take off? Insurance? What kind of DeFi products are we going to expect to see in 2021? And I think let's kick this off with Paul.
Wow, putting me on the spot. All right. So what DeFi projects do I see growth in 2021 is the question?
Projects or trends or categories.
Okay. So I think right now we definitely see some DeFi consolidation in terms of the top projects. And what that means is that they're building out vertical and horizontal integration. And on the other end, I definitely think that we're seeing a growth on the aggregator side with these various exchanges like Uniswap, SushiSwap retaining volume. You also have growth in the aggregator end like Zapper, DBank. And I think once those projects start rolling out tokens, I do think we'll start to shake things up. All right, next.
Gonna hop in. I think I agree with a lot of what Paul laid out there. Maybe to touch on a couple other trends to look out for. In 2021, I think for the first time, you'll see like a mass migration of applications and developers to layer twos and other alternative chains from Ethereum. I think we saw like the first taste of that in 2020 of people starting to explore other opportunities, but now that space will explode with Parachains launching and IBC kicking off, and Optimism and Matter Labs probably launching this year here pretty soon. So a lot will change in that landscape. Like the sort of Ethereum main chain monopoly, I think, will start to decrease a little bit. And then I think a lot of apps will be looking to, like the sort of DeFi we have right now, to me seems like DeFi kind of 1.0, and a lot of apps will be trying to figure out how they can iterate their designs to become more capital efficient. And it'll be sort of I think it'll be an interesting race between like the incumbents and sort of the challengers, as people try to sort of, the existing teams try to iterate their designs and new teams come in with like marginally better models. It'll be interesting to see how that plays out. And then just the one last one I had in mind was, I think it'll be interesting, hopefully in 2021, but if not, for sure 2022, you'll start to see maybe the first examples of like private DeFi, either on Ethereum or even thinking outside of Ethereum. I'm thinking of a couple projects that are doing like privacy focused DEXs, or even, like there'll be like Alio is going to launch basically like a computation platform for private applications that allow developers to build in the context of like a privacy preserving blockchain, which would be pretty cool.
Yeah, so I guess my turn. So at Arca, we kind of break down our roles by covering sectors. So the main one I end up covering in DeFi is DEXs, as well as covering CeFi. So mainly just exchange based on my end. So I'll kind of show my own book here and talk about DEXs. I think we can continue to see a lot of growth across the board, especially for the main names within it, Uniswap, SushiSwap, as well as some of the aggregators for like 1inch. I think what's going to be an interesting trend in 2021 is really how these projects continue to become more efficient. So for that, as well as building out verticals on top of excess liquidity in some of these AMMs. So whatever that includes in V3, as well as what SushiSwap is really doing with building out a lending and borrowing platform on top of it. So I guess for an investment theme in DeFi and kind of sticking with DEXs is capital efficiency across platforms and across business lines to continue to like build out cash flows to token holders would be what I would expect to see continue.
And super quick, and this is open to all three of you guys. So I think two of you mentioned DEXs and DEX aggregators. Just for the general audience, for those who do not know what DEXs are, oh, perfect. We actually got one question from the participants. What are decentralized exchanges? And then what is sort of the intent of it and the difference of traditional exchange in the legacy system? And anybody can answer
Alex?
this.
Yeah, I can take that.
Okay.
I was hoping someone else would.
Exactly.
Decentralized exchanges are really just exchanges without really any limits of what assets can be listed on it. So Robert or Jacob or Paul could go add an ERC20 onto Uniswap, and that could become publicly traded. So where this differs, and I guess I'll talk on traditional markets and both CeFi here, is that you really can't see stuff like what happened today with GameStop in a DEX. You can't halt trading. There's no circuit breakers, and it's really just fully open markets here. So I think that's really interesting, especially for like a Uniswap, is because they are able to list these new assets so quickly. So that is, at least from what we see in 2020, is it's really starting to eat away at a lot of these tier 2 exchanges in crypto. And we'll see in the future on how that impacts traditional finance as well.
So now, I guess a follow-up question to that, what is the value proposition of DEX aggregators and what is their intent?
All right, someone else's turn.
Take that one. So the thesis around DEX aggregators, from my understanding, is that liquidity is generally understood as a commodity that flows to the best venues, and that necessitates that each venue has different prices. So the aggregator comes in and scopes out, either through smart order routing or whatnot, which venue has the optimal price, and then the aggregator can take a cut on top. And the reason why that's pretty impactful is because if a liquidity venue beneath the aggregator tries to take a cut, they're not going to get liquidity pulled from the top side from the aggregator. The aggregator might just pull from somewhere else. So it ends up being the aggregator who can extract the most value from that flow. And so, but that's one thesis. But then you look at something like Uniswap, who is on a lot of the times doesn't have the best execution, but has retained massive market share in terms of user base and unique users going to Uniswap over other aggregators. So it's definitely possible that Uniswap builds out an aggregator on their end, or just continues to control the user and can extract immense value from that.
Yeah, that was incredibly well said. Jacob, real quick, I know Polychain presumably has a couple bets in the DEX space. What are your thoughts? What are some projects that you see are going to, outcompete the others? And then maybe what are your thoughts on, AMM and maybe AMM designs in DEXs?
Yeah, for sure. So I think in terms of Polychain's bets in the DEX space, honestly, we're probably more geared towards order books and AMMs at the moment. I think we have investments in at least a couple AMMs, one of which sort of built on Polkadot. But the general takeaway for us is that over time we'll see a shift to the more capital efficient model of order books. And honestly, now that we have kind of seen that DeFi is definitely happening in 2020, basically with this explosion, I think it's pretty clear that over the next few years we'll probably see an uptick in liquidity on order book exchanges. But back to your question about AMMs, I mean, AMMs have kind of just blown everyone out of the water, and I think that it's been like an incredibly amazing tool for bootstrapping liquidity on the long tail of DeFi assets that has emerged. You've seen all these different governance tokens and DeFi tokens pop up and have been able to have relatively liquid markets at extremely low cost. I mean, that's something you couldn't do in a traditional market. And before Uniswap really took off and people started incentivizing liquidity on Uniswap, there wasn't a way. It was sort of like tokens would launch and their token would have no liquidity, and there'd be no way to trade it, and then maybe they'd strike some deal with a market maker where they're paying them way too much to make markets for their token. But it was just a terrible UX, I think, for projects. In terms of different designs, the cool things, so like I think that Curve is a really cool model. Basically, like X times Y equals K market maker is like the most basic form of market making you could come up with. And there's going to be some there already have been some interesting iterations on this model to be more efficient with the capital that's pooled in the smart contracts. So like Curve and Saddle, I think, are good examples of this, where they sort of, because you're trading two assets that are alike and you expect them to pretty much trade at parity, you can use a much different curve than you would for a traditional two asset pair. And in the context of like Curve ends up being actually more efficient to trade on a lot of times than trading stablecoin pairs on centralized exchanges, which is like pretty crazy to think. And on top of that, I think there's stuff like Dodo and Cofix, and I'm sure there's others that are trying to like optimize even further and basically encode more intelligent logic into the smart contract to allow the market maker to be a better market maker. I mean, that's basically the whole idea. Like AMMs at the end of the day is just the logic of a market maker encoded on chain. And so any way you can improve that, whether that's using an oracle to get a price outside, or checking what liquidity looks like on an order book exchange to sort of like adjust the way that the smart contract is providing liquidity on chain. There's all these different optimizations I think people can do, and we're probably still early into the design space of what that'll look like. And probably the best model going forward in 2021 and beyond is to start with sort of AMM, basic AMM, and start adding on limit order functionality to try and blend the landscape between order books and AMMs. I don't know, maybe Alex or Paul have other thoughts on that.
I mean, yeah, I tend to agree with that, especially with the order book functionality added on top. In terms of all the additional projects, and kind of answering one of the questions that's already in the Q&A on why there are so many DEXs, it really is just reiterating or iterating on top of Uniswap so far. Whether this works and these actually start to receive real volume outside of what's incentivized, real liquidity outside of what's incentivized, I don't know. I think it really comes down to, at least from investment purposes on our end, where are the customers? Are those customers sticky? And then what are the valuations, and how is value flow through to the token?
Real quick, just to sort of add on to both of your points, do you think there will be a future where we're going to see on-chain order books on Ethereum, or do you think those are going to sort of migrate to maybe a chain like Solana? And if you do think it's going to be on Ethereum at some point, how do you see that evolve?
On-chain order book on Ethereum main chain, at least, would be super difficult to do. I mean, it wouldn't be doable. The UX would be so bad. There's market makers would make markets in market with 15-second latency. If projects move to layer 2s, then you could perhaps see some sort of on-chain order book, but even then it wouldn't be super great. Like, even in that model, I think that probably the off-chain order book model still sort of would be the best way to go. Like, the short of it is, this is one of the things about DeFi is, like, I don't think in all cases DeFi necessarily has to be fully trustless. It's really about, how can we reduce trust in different instances where it's demanded. And so, like, in the case of order book DEXs, a lot of times the trade-off of, having increased latency, but you have a trustless order book that's all on chain, isn't really worth it. And, traders instead would rather have a centralized order book run by an operator so that they can have sub-second latency, a much better UX, a UX they're used to on centralized exchanges, but then they can still benefit from, like, the non-custodial aspect of being on Ethereum. So I think that's probably the way it will go. If I do think that, like, Solana or Vega's another one that is trying to do, like, a fully on-chain order book. The issue is that I think the other thing to consider is that operationally it becomes difficult to, even off-chain order books, but for sure on-chain order books, operationally it becomes much more difficult, I think, for market makers to plug into that. And so it'll be a steeper battle, definitely. And especially when you're moving from Ethereum to a new layer 2, or a new chain or layer 2 or whatever, you lose a lot of the developer tooling, a lot of the infrastructure that's already built on Ethereum. So it'll be an uphill battle, but it'll be interesting. I think that the idea of having a fully on-chain order book is definitely appealing if we could get there, but at least in the very near term, it'll be difficult, I think.
Yeah, I have nothing else to add there. I mean, I would definitely prefer an on-chain order or an order book model, but what Jacob said, it's very difficult.
Paul, any parting words?
I think, I agree with almost all of that, or all of that. Just to add, AMMs in their own right unlock some functionality that order books don't have. Like, LP tokens are, like, incredible in a sense that it unlocks so much composability potential. So I have idle assets. I throw them into a AMM, getting some yield. I have an LP token. I go borrow against my LP token, and I have more yield. It's like this stuff is like 0 to 1 compared to order books. And order books are great in terms of execution, but there's something to be said about composability of DeFi protocols and DeFi assets that is kind of the bread and butter of why we're here and what DeFi unlocks, in my opinion.
Yeah, no, that's a fair enough statement. I want to sort of get to some quick questions here that the audience has asked. When will stocks start to be traded on DeFi? And so that can really be sort of a broad question to synthetic assets or anything of that nature. And yeah, anybody can speak to it.
Need an Oracle feed, right? That's it. It's kind of, you just need a price feed for it depends on who's your counterparty, right? What protocol or who's going to take the counter, like who is going to, like for synthetics right now, if they wanted to throw in a stock, the debt pool is the counterparty and all they need is a price feed. And I think Mirror Protocol, you already can trade some synthetic stocks but I'm not completely up to date on that.
That's right. I think the only reason that we haven't seen more stock trading in crypto is because of like the regulatory issue of I think like Synthetics has been looking at adding stocks for a while, but has been hesitant because they're afraid that they're going to get hit by regulators. But yeah, Mirror has it, and Blockfolio just added some sort of stock trading today. I'm not sure where that falls in the DeFi spectrum, but I think that people are definitely looking at the last 24 or 48 hours and recognizing the opportunity there is to create some sort of stock action on chain. So I think within the next, call it month or two, I bet we'll see a couple products pop up to take advantage of this opportunity.
FTT just moved because of that whole narrative. We'll get Sam to make some ERC20 stocks and then throw them on chain, and then that's it. That's DeFi.
There you go.
Probably be out tomorrow.
Another quick question that I thought was pretty interesting here, and maybe Jacob, you could begin with this. Can you talk a little bit about Optimism's recent soft launch, and then maybe even what some layer 2 scaling solutions you think could be really, or have a really high potential down the road?
Yep, for sure. Yeah, so I think Optimism has been, so I'm not a total expert on this, but I can at least recap what I do know. And Paul or Alex, feel free to jump in here if I misspeak. But my understanding is that Optimism for a while has been running this sort of private test net where they're onboarding like Synthetics and maybe working with Uniswap and maybe a couple other teams to kind of test out their functionality. And I think it's still sort of a work in progress. Like it's not fully ready to launch, hence the kind of soft launch. But I think that the Optimism team has been working hard, and within, in the near future, they'll be ready to go with an optimistic rollup. As far as speaking to the broader layer 2 landscape, there's a number of different designs from like sort of standard optimistic rollup, which would be like Optimism and Arbitrum, to ZK rollup, which would be like Starkware and Matter Labs is building a ZK Sync. And then there's also like side chains, but like Matic and XDAI is the other one. And they all come with different kind of trade-offs, I think, in terms of the trust model. But what I think is interesting is even at this point, we've already seen different teams saying they're going to build on different chains, to the point where it's pretty clear, I think in my mind, that things are going to look a whole lot more spread out than we originally thought. I think when Kane released that, Kane from Synthetics released that article basically saying like, the layer 2, choosing which layer 2 to build on is more of a coordination game than it is a technology problem. And I totally agree with this. And with this in mind, it's interesting to see that teams are spreading out a whole hell of a lot more than I think we maybe had considered that they would. And this, I think, is evident of different teams choosing to take up different trust models. And so I think we'll end up seeing sort of different ecosystems emerging on different chains. And the real sort of challenge, I guess, then will be interoperability between different L2s.
Yeah, I love that explanation. I also like that you sort of mentioned the trade-offs, and so that kind of leads into a really good question here that someone else brought up. And I just want to touch on this briefly before we go into some more DeFi-focused topics. But how long do you guys think Ethereum will stay the leader in DeFi? And what other layer 1s do you see emerging? And then maybe another question to that would be, what do you see as the future for the internet of blockchains? Yeah, and if you or Alex or Paul would like to answer that to start off, that would be great.
Someone want to start this one?
I mean, personally, I don't have a ton of opinions here. We don't really invest in a lot of different layer 1s. We rarely hold Ethereum most of the time. We think we can replicate that exposure in DeFi. I mean, my point of view, probably for the foreseeable future. And then I just really don't have an opinion on internet of blockchains. So rather than giving you a bad answer, I'll give you no answer.
Wi-Fi cut out and I missed that entire question.
The question was, how long will Ethereum keep its leadership role in DeFi? And what are some other layer 1s that you see will emerge in the next couple of years?
I would say very high probability that Ethereum stays the leader. It'll be interesting because there's just no assets on top of other chains that are really pulling users to that chain. Once you start seeing attraction on that end, then things will just kind of follow suit for that chain, right? And that's when I would bet on that chain. For example, if assets are high in demand, that can and there's farming on that token, then they'll flush in stable coins to that chain to farm that token. Then you'll have like a lending market for the stable coins on that chain. So I think once you have there needs to be a project on top of a layer 1 that really brings in users. And on one project I can think of maybe is Serum and the Solana, because it's hard not to bet against SAM. Direct connection to a user base. Wait, did I cut out?
Second.
Just a minute. Wi-Fi, my God. Okay, what am I still good? So I would say if I had to bet on one project or two projects, might be Polkadot or Solana, and Solana simply because of Sam's pull.
I think I agree with Paul largely there. Ethereum's probably going to stay the leader for a while just because it has like everything, the developers, the users, the tooling, you name it. But I do think that there are worthy competitors for sure. And Solana's an interesting use case specifically because, if you take Serum away, Solana seemed like it was going to have trouble. But it turns out they were one killer app away from having a real ecosystem. And now you see like there's a number of teams building in and around the Serum DEX, and I think that people are starting to realize that like because there is Serum to bring in users to the platform, there could be an ecosystem develop. Outside of Ethereum, I think the two places I really see sort of developer and potential user activity is in the two sort of platforms building around application-specific blockchains. So Polkadot and Cosmos. I think they're both have their place. I think in sort of a post Ethereum monopoly world. Polkadot specifically, I think, has just blown me away. Obviously, Polychain's a huge Polkadot investor, so maybe I'm biased there, but I like to at least think that I came to this opinion kind of independently. And the reason is, like, I think I started off as a little bit of a Polkadot skeptic, but after looking into it more, like, it's crazy how much development is going on. Pick any subset sector of DeFi you can think of, like DEX, lending, like the stablecoin space, even stuff kind of adjacent, like privacy, NFTs, you name it. There are 5 or 6 teams building in each of those subcategories. And, you know, when they launch Parachains, as soon as they're able to kind of scale that up, you're going to have tons of assets on the Polkadot platform in a way that you won't see on any other chain. And I think that it's just, you know, things are exploding. And I think that people are starting to realize, like, the benefits of, you know, moving over to something like Polkadot. You seem to get a relatively similar trust model, but with the opportunity to build on parachains that are a little bit more optimized for specific use cases. And so, you know, especially in a world where we start spreading out across a number of layer 2s on Ethereum and lose some of the composability that Paul was noting as like a really key advantage of Ethereum, you may see people start to much more seriously consider what it would be like to exist on a Polkadot or a Cosmos or a Solana. Because at the end of the day, like, building on a side chain that's siloed off from another side chain will feel the exact same as building on another chain that's siloed off from another chain. But even then, we'll get interoperability here, I think, in the next few months anyway. So hopefully some of those barriers will come down.
Hey, Jacob, real quick, for audience members that might not know what parachains are, what are parachains and how are they uniquely suited to decentralized?
Sorry about that. So real quick, Parachain is sort of like so the basic way to think about it is, if you're familiar with sharding in Ethereum, the basic idea is that instead of executing everything as one single chain, we break it up into sort of mini sub-chains, if we want to think about that, or even, yeah, sort of sub-sectors of computation where you have a subset of the validators kind of, you know, gathering and executing transactions on each of these mini sub-chains, which allows you to sort of like work in parallel. Polkadot basically takes that model and, you know, in Ethereum, the idea with sharding is that all of the chains will exist under the same sort of EVM model. They're all kind of like homogeneous. All of the shards are the same. In Polkadot, the idea is that you could have each of these chains be its own blockchain and be optimized for a specific use case. So you can sort of think about Polkadot as like a chain of chains, where each of the parachains is a chain in of itself that then has all of its blocks. It basically surrenders consensus to this sort of relay chain, which you can think of as like the hub in the middle of all the parachains that gathers transactions and executes blocks according to what's gathered from each of those parachains. And the cool thing about parachains is you can basically think of these as like an app on Ethereum. Rather than executing it as a smart contract where I, you know, kind of inherit a lot of the properties of Ethereum, you can instead build on Substrate and become a parachain on Polkadot, where you have a whole lot more flexibility. So you can do things like optimize the economic model. You can choose sort of like how data's structured within the chain more. You can choose to have an EVM virtual machine, or you can have a WASM virtual machine, or you can have a non-Turing complete virtual machine that only has a few different things you can do. And so you can optimize a lot of different parts of the kind of core infrastructure of the chain that you wouldn't be able to do if you were built as a smart contract.
I love that. I love that explanation. I'm glad that you also mentioned parachains, just because, you know, in order for the space to, in my view, to move forward, you need these, or really for these applications to migrate to other chains, you need to sort of allow these developers that have gotten comfortable with Ethereum and the Ethereum virtual machine to still operate, you know, EVMs on different chains. So I think that's great. One quick question, sort of for Alex, that and this is a great segue to that, is I know that our Arca is one of the biggest, or is a huge investor in the Grayscale trust sort of trade. I would love for you to sort of explain that to the audience. How does that work, and how is Arca making money on that end?
Yeah, I'll do my best. So to preface this trade was put on before I joined full time, so I wasn't a part of it. But I'll give you guys my understanding of it. So pretty much, if you are, I should probably start with what these Grayscale trusts are. Essentially, it is a way for you to gain exposure to Bitcoin through the Grayscale Bitcoin Trust through traditional market means. So you could use it with your IRAs. You could do so. You could pretty much do so just trading on your TD Ameritrade or whatnot there. What's interesting is that the Grayscale holds a certain amount of Bitcoin, and that is considered the NAV, so net asset value of a share of the Grayscale trust. But that Grayscale trust doesn't usually trade at that NAV value. So that is where the free flow of a market prices that. And now it's interesting, if you are an institutional investor, you can put Bitcoin in at the NAV value, and in 6 months for a 6-month lockup, you can then receive shares of the Grayscale trust. So if you're looking across the different Grayscale products, you have Bitcoin, which trades at about 20% premium to the net asset value. You have Ethereum, which up until a recent unlock traded at anywhere between 30 to 100 or so % of that premium, or of that NAV. And then you have smaller things like the Litecoin Trust, which trades in the thousands of % compared to that NAV. So after your 6-month lockup, you receive the shares of the Grayscale Trust, where you've put in at the NAV value, you receive the respective amount of shares, and you then sell your shares. So in instance, this is what I was talking about before when I mentioned that we do a fair amount of arbitrage, not so much your exchange to exchange arbitrage that you see from some quants, but we are just capturing the difference between the two. So to kind of recap, you can put Bitcoin in if you're an institutional investor. 6 months later, you receive the amount of shares based on the amount of Bitcoin you put in, and you capture the difference.
Yeah, so just to sum up, don't buy Bitcoin through Grayscale. You're getting a pretty bad deal. Paul, real quick, I know that you've done a really fair amount of research into algorithmic stablecoins. I was wondering if you could sort of some of the recent projects like Frax and Empty Set Dollar, and then maybe Jacob, if your Twitter is correct, why are you so optimistic about Celo and the potential there? So yeah, let's have Paul start first.
I actually did not lead those reports. Those were MJ and Jan, who they just published a Frax report, and they're working on a DSD one right now. But so I'm by no means an expert, but from my understanding, for example, for ESD, when supply is above the peg, you can lock your ESD in the DAO or supplied in liquidity pool, and you receive minted ESD that compounds over certain epochs. When it trades below, you don't have those incentives, but you can buy coupons and burn them. Like say you buy it at 30 cents and then you buy a coupon at 30 cents. If they trade above $1, you can cash those in for $1. So that's kind of the dynamic there. The issue with this whole thing is, one, it's a big whale game. Two, ESD and DSD, they incentivize locking up your capital in the DAO rather than using it. There's like the opportunity cost of actually using your ESD when it's trading above 1 or selling it is just so high because the yield is so high. But Delphi, we are working on aspects to change the econ, which I can't share yet, but we have some ideas, and that I think that's going through a proposal soon.
Fantastic.
Sweet. Yeah. Maybe just to jump in there. Yeah, I think that the algorithmic stablecoin space is so insanely exciting because in theory, if an algorithmic stablecoin worked out, it would have better stability properties, it would be more scalable, and it would be more trustless than something like MakerDAO today, which is sort of like the gold standard. And there's been a number of different models that have come out, like fully uncollateralized stablecoins like ESD and DSD and Basis Cash, and then like Frax and Celo and and sort of ESD v2 all fall under the like partial collateralization standpoint. And I think the reason, I think that Celo is really interesting just because like one of the problems that ESD and Basis Cash have had, and is that you're trying to bootstrap trust in a system that doesn't exist. Like I can't even describe how insanely hard it would be to sort of create a stable value out of nothing. It's sort of like Bitcoin is this once in a million years experiment that just like happened to work out. We're sort of trying to do that with stablecoins right now. And the problem is that like if the economics are off just a little bit, you can get into these really weird situations where it's tough to kind of climb out of. And the interesting part about like the original Basis protocol and also what Celo's done so far is that they have sort of it's a little bit of a different model, I think, from the start, but Celo just has a whole hell of a lot more resources, I think, to kind of like bootstrap off of than some of these other protocols too, which I just think is interesting. So Celo has this like massive reserve of assets that is used to sort of provide stability and grow the ecosystem in the early days, coupled with a fully algorithmic stablecoin design, similar to Frax, I think, to some degree, which I think is going to allow them to, hopefully stay stable for a lot longer, and at least, maybe be able to bootstrap Celo up to the point where they can survive on sort of partial collateralization or beyond that. But the biggest issue I see with the algorithmic stablecoin space right now is that there's sort of this catch-22 where you need demand to, the basic thing is like a stablecoin is worthless if it's not stable. That, like, first and foremost, from first principles, that should be the thing you're optimizing for. And I think not all of the stablecoin designs out there that we have today are sort of optimizing for that entirely. And so things like Frax or Celo that have sort of, sort of reserves in the background to sort of provide stability in the early days before we are able to get to the point where we can bootstrap off, or we can be able to survive on mechanisms like bond or coupon mechanisms, I think is really helpful. And you see ESD kind of moving that direction for that reason. And yeah, I think that users would prefer to have an algorithmic stablecoin that they use instead of a collateral backed one. But until that, those coins show enough stability to merit usage, people just won't use them.
So just to follow up on that, I know that some of the recent proposals for, I think, empty set dollar has been something like introducing a fractional reserve requirement. Do you think that's something that could maybe help stabilize, stabilize these, algorithmic stable coins as they mature in market cap?
Yes.
I'd second that.
So explain maybe for the audience, what is a reserve requirement and why would that help stabilize potentially some stable coins?
I mean, it's just, you can, sorry, go ahead.
No, you're up.
I mean, it just gives you more trust that you can redeem your stable coin or algorithmic coin for some underlying asset, right? So if you have some supporting it, whether it be 20% to 80%, that changes your risks of holding that stable coin. So just as simple as that, I think, is just you have a reserve backing, some reserve backing it.
The whole idea behind an algorithmic stablecoin is that, as Paul was describing, if the price is above $1, we mint new supply. If the price is below $1, we burn supply. Minting supply and selling it on the market is super easy to do. You can do that through a contract, or you can give it to people, and eventually, if the stablecoin price rises hard enough above $1, people will sell it. Like that's not the big issue. The big issue is, what do we do when the stablecoin is trading below supply? Like, how do we decrease supply to return the peg to $1? Short of prying tokens from people's hands, there's not like a great way to do this. And so people have come up with different mechanisms. Like the coupon and bond mechanisms are supposed to incentivize people to burn their supply to return the price to the peg. And there's different sort of reward structures in order to do that. The holy grail of algorithmic stablecoins would be where there is a reserve, where I know that I can always redeem my stablecoin for $1 worth of collateral backing it. Obviously, having a fully backed reserve, like fully backing the whole supply of the stablecoin, ends up being pretty capital inefficient. And so the idea is that maybe we could get to the point where we don't need, like it's possible we don't actually need, it's similar to like fractional reserve banking. It's possible we don't need a fully collateral backed stablecoin. Maybe if there was 20% of supply backed by collateral, people would know that short of a bank run, there would always be enough collateral to backing the stablecoin, such that if I wanted to redeem my token, I'd be able to get $1 of collateral. And so that, I think, is sort of the vision that ESD v2 is going after, trying to find that sweet spot of enough of a reserve to keep the stablecoin relatively stable, but not enough of a reserve that it feels too collateralized or something. So it's kind of a happy medium.
If nobody sort of has anything to add on to that, I think that's a really fantastic segue to what is potentially, fixed rate lending, because you sort of mentioned coupons. So generally speaking, lending is one of those products that really needs to mature in order for the space to have consumer adoption, right? What are some really unique lending applications that you're seeing today? And then maybe what are your thoughts on proof of stake yields providing a unique opportunity for lending applications? And then let's have Paul real quick start with, just generally, do you see any cool lending applications out there?
Like lending applications like Aave, Compound, Cream?
Yeah, exactly.
Okay. Yeah, I think the pooled lending model in of itself is pretty innovative, and we're seeing a little more projects like Cream, for example, going down the road with uncollateralized lending for certain protocols like Wi-Fi, where now you're having a protocol whitelist another protocol on under collateralized lending, which I think is quite cool. But it does shift that lending risk or risk to depositors on Cream who are not Wi-Fi depositors. So you have and then you have another cool aspect of lending pools is that lending pools that are both AMMs and lending pools. I know there's been some research on that end, but I don't know. I can't speak to anything else. Do you guys have anything other input there?
I can go ahead. Yeah, similar to what Paul said, all the innovation on Compound, Aave, from how they're creating their lending has been incredibly innovative and really interesting. But there are drawbacks, especially with variable rate lending. If you look at times a new yield farming product shows up and it's using a certain underlying collateral, I think the best example is probably of when YAMMs first existed before it blew up. Aave lending rates for those underlying collaterals were flying. And so that when you have a variable rate like that, it is kind of painful to the borrower. Well, yeah, to the borrower on the rates they have to pay that probably don't make a lot of sense for a lot of businesses, even though it is very beneficial to a lender. So I think that is really interesting when you start to have these fixed rate lending platforms, especially from a business to business standpoint. Whether they take off because people are using them to yield farm, probably not. I think these are more or less protocol to protocol or business to business type platforms where you need that set 4% rate and only receive that 3-4% back when you are lending.
I think I agree with everything Paul and Alex have said so far. It's the short of it is that the lending space right now, relative to sort of the TradFi lending space, there's this huge gap in terms of capital efficiency and user experience. The lending space that we have right now is just looks nothing like what you would expect to see in the traditional world. And so part of, I think, the question for a lot of these new lending startups is how can we sort of mend the gap? Part of it is introducing fixed rates. Part of it is Cream doing this sort of B2B under collateralized lending protocol that they have. That's pretty cool. And then part of it is trying to figure out different hacks to get to a point where we could have under collateralized lending on a peer-to-peer basis. And people are jamming on these different ideas, and I think we're kind of moving along with some incremental improvements, but definitely excited to see more innovation in that space.
Fantastic. Just a follow up to that, Jacob. Any cool fixed rates lending protocols Polychain's looking at, or anything that you like yield or?
Yeah, that's a good question. There's definitely a few out there. I think the fixed rate lending space is becoming really crowded. Like there's a ton of different protocols on the market, but we actually just had one come through the Polychain incubator, project by the name of Greenwood. Check it out for sure. Real cool guys building that, and yeah, it's based on Row protocol, but we'll have some innovations coming up in V2. I think that'll be exciting. But yeah, I guess not too much to say there.
So then, sort of for all of you guys, since lending seems to be a little bit crowded, DEXs seems to be crowded, is there a subcategory of DeFi that seems to be maybe under crowded or underdeveloped that you'd really like to see more projects get into?
Yeah, I can go ahead and start on this one. Definitely not uncrowded, but definitely not a developed market at all yet. I think probably one of the biggest innovations we'll see across 2020 is really starting to see decentralized derivative markets start to be built out. Now, there's already like 15 different projects at least that I know of, and as a venture capitalist, I'm sure Jacob and Paul know a lot more than I do on this. But I think that is probably going to be one of the biggest markets in decentralized finance.
To add to that, what we're seeing is just kind of three routes that these projects are taking. One are like specific on-chain designs, whether it be on-chain perps or on-chain options. And then you have second, the more generalized projects like Synthetics or UMA or Opium. And then you have lastly, the ones that are going for more the optimized route, DEXs or derivative-based DEXs who are optimizing for centralized exchange efficiency. And you see whether that be creating their own chain or operating on a more optimized layer one, for example, Serum. That's another route that exchanges are going for. And in that bucket, you can look at like Derivadex, DYDX, Serum. So, and then on the on-chain perp side, you have Perpetual, Future Swap, and then the on-chain options, you have Hedgic, Potion, Charm, Pods, and Primitive. There's a whole bunch. So definitely not definitely still crowded, but the TAM is huge. So we'll see.
Yeah, that's the thing about DeFi is that all of these markets, like you think about it, the winning protocol in each of these, or the winning, or maybe the couple winning protocols in each of these subcategories of DeFi that are porting over traditional financial structures to the decentralized finance space. I mean, these could be 100 billion, I don't even know, who knows, maybe like $1 trillion protocols one day. Maybe trillion is too much, but either way, very, very valuable. And so there's like a number of teams, like a handful or a couple handfuls of teams going after everything. And so it sort of like all of the obvious financial products that you could build, I think have been sort of taken up already. And so part of, I think what I'm trying to ask myself is like, what are the weird stuff that might come next? So like, I think that, I think thinking about like markets for new assets that couldn't have existed before are pretty interesting. That's sort of a broad mandate there. But I also think that like Reflexor is pretty interesting in that it's sort of like creating this new asset that maybe you couldn't have outside of a crypto context. I think there's a couple other projects that kind of are mimicking are doing that as well. It's sort of like, what are some new things that we can only create in a DeFi context that like don't exist in TradFi? Those are probably like the most interesting things to us at this point.
I would almost say that all the TradFi tools are not even close to here yet. Like you could have CDSs, all these different types of tools that when they work within crypto would be incredibly interesting, at least from like a portfolio management, portfolio construction view. So I mean, I think this entire space, no one is a clear winner across the board, and whoever ends up winning it will end up being a gigantic project. So, I mean, I'm pretty much waiting to start to see where the traction falls and where the growth is. But I think this is probably one of the most interesting areas within DeFi to invest in right now.
Yeah, to add to that, like where would you see like near term growth? It's like, what are the pull factors for these derivative exchanges where they're clearly not as optimized as centralized exchanges and the experience is so much worse? Okay, what can you do with certain protocols that you can't do on a centralized exchange? So you have one push factor is the KYC aspect, but then the real kicker, I think, is just being able to utilize your positions on like on-chain options or on-chain perps and various other protocols, because that's simply, you can't do that on centralized porting that over. You can't do that in traditional finance. So that's an immediate pull factor for on-chain derivative protocols that some other projects who are tackling more of the optimization route don't have that pull factor, which is just some place that I can see pulling in users, in my opinion.
Yeah, Alex, I know you mentioned credit default swaps. So super quickly, how do you see that sort of developing on chain? And then I have a follow-up question. PG from PG is: do you think what happened today with Robinhood, staying on the topics of derivatives, do you think Robinhood, do you think the Gamestop trade could have happened in the crypto world?
Yeah, I mean, credit default swaps are an incredibly interesting tool that more or less get a terrible rep because they blew up the economy in 2008. But they're really used for risk management. So we're starting to see real insurance protocols and people actually using this insurance. Well, if that's tradable, if I can go long or short some of those insurance contracts, that's again another very interesting strategy from my point of view. So whether these are being used for trading aspects or whether they're actually being used correctly for insurance and risk management, I think both have a very interesting case in a decentralized fashion. And then, yeah, just to reiterate what Paul was talking about earlier, how these can all be worked together is also kind of what Jacob was getting at in terms of new products that are only going to be able to be created in crypto. I think you can still create a ton of different toolings from TradFi that have all these unique use cases within crypto that are incredibly interesting from a long-term view set.
And then thoughts on the GameStop trade?
Anytime you have low
right now.
liquidity options, something that is very apparent in crypto, you're going to have a lot of gamma squeezes. So yeah, I think this can happen here.
And Jacob, just because I know the audience will kill me if I don't mention Bitcoin, would you mind kind of giving a quick overview of and this is really a general question to all three of you guys, because I know all three have a pretty strong opinion on it, but what is the Bitcoin thesis going into 2021? What the hell happened in 2020? And what does it all mean for Bitcoin?
Yeah, for sure. I think 2020 and the maybe early days of 2021 maybe looked back as a pivotal moment in terms of Bitcoin's kind of many years. The short of it is, as I kind of described before, I think that Bitcoin in theory is like an experiment that probably shouldn't have worked out, but the stars aligned and here we are. And throughout the different cycles, I think every kind of bull market to bear market has ended somewhere in a scenario where I think a lot of people, even insiders, questioned whether this thing would even survive. In this latest bear market, kind of 2018, 2019, into like the early days of the bull market in kind of late 2019, early 2020, I don't think there was a doubt in people's mind that Bitcoin in the crypto space was going to survive. The question was only like, when is the next rally and when are more people going to come into the space? And late 2020 into 2021, I think that we saw, it was sort of like things were moving slowly, and then all at once, everything started happening. You had institutional investors announcing they were getting involved in Bitcoin. You had freaking, Paul Tudor Jones and Stan Druckenmiller, of all people, come out and be interested in Bitcoin. You had Ray Dalio today said that he at least is considering the possibility. You had the Bank of Singapore, a chief economist there, said that Bitcoin is interesting and might replace gold. So at this point, it's very clear, and I think that one of the interesting ways to frame like what 2021 will look like for Bitcoin specifically is that there is absolutely no doubt, I think at this point, that Bitcoin will continue to be around. And at this point, it is just a matter of like, how soon do people start adopting it? And one way to frame this is like, up until this point, up until probably 2020, up until maybe late 2020, like this most recent rally, there was always this sort of career risk as an institutional investor. Like if I work in an endowment or big money manager, it would be a little risky for me to be like, hey guys, we should maybe buy Bitcoin. Now we're to the point where Bitcoin has been around for so long, there's been so many different cycles, so many different opportunities to get in, that there's like career risk associated with not saying we should buy Bitcoin, And I think that this is like, over the course of 2021, I think you'll see a lot more players kind of pile on into the action to try to get their share of the pie as this market grows and grows and grows. Even with where we are now where it feels like there's been so many big names come into the space, we're still at like a fraction of the total market cap of gold, which seems like potentially a lower bound for like what we could imagine Bitcoin might come to. So there is still so much opportunity in this space. And, as momentum keeps building, the Bitcoin will continue to be sort of a steamroller.
Yeah. I think just Bitcoin narrative has never been stronger on a macro basis. In terms of indicators, what we've seen is when Bitcoin ripped to 40K, definitely overextended and needed this retrace. We're in a pretty healthy position right now. Last time I looked at the indicators, we had like resets in the SOPR, and MVRV is like in a much healthier spot. And what separates this cycle from latter ones is the buyer just might be different this time, and you can kind of tell that with anecdotally through like the institutions buying. You have Paul Tudor Jones talking about Bitcoin, but you can also see it on chain a little bit. Like the metrics, Bitcoin is being flushed from exchanges. You have Bitcoin move to illiquid venues, which You didn't see that in other run-ups, as well as you continue to see whale growth during this move upwards. So it just like you said, but you still have to be careful. Like you don't ever want to overstep yourself. Like history doesn't repeat itself, right? It rhymes, but it rhymes. It's different in like nuances. So I think there might be this cycle might be a little bit different just because the buyer is different. And if we definitely saw profit like long-term holders taking profits, but if those profits are cycling into potentially other long-term holders, then that kind of nullifies the indicator overextension. So it's definitely going to be a fun cycle to track, but it's definitely I'm bullish.
I would be very wary of calling Paul Jones a long-term holder, but that'd just be my opinion on some of the traditional finances or funds getting into the space. I mean, yeah, I wouldn't say I have any sort of edge on Bitcoin at all. I think it's an incredibly interesting asset. And if there was ever a time for an asset like Bitcoin to work on a macro time, like this is it. So yeah, definitely bullish Bitcoin continuing in 2021.
I mean,
sorry.
Go ahead.
I think I'm lagging. Sorry, I think I'm lagging quite a bit. So if I cut you off, I'm so sorry. I couldn't hear you.
Hey, no worries, no worries. So just to kind of wrap this up a little bit, because I don't want to take too much of your time here, because I know we're already a little bit past 9. But to wrap it up, out of sort of all the projects in the DeFi space, if you could name one project to put all the money you have, which in my case is maybe $2, all the money you have to one project, what would it be?
I guess I can go in if I'm not cutting anyone. I would say I would just look at it as like a function of the team and their staying power, right? These things are liquid tokens, and the only thing that sustains their value is the continued execution of the team and the community behind it. And so if you have one project, probably either Aave or Uniswap, just simply because they survived the bear market, fantastic team, strong investor base, and good community. But if I had to, I also, side note, I think Yearn could be that, but not right now.
Yeah, I mean, hard question. Not the type of fund we are. Betting super long term. Our time horizon can be anywhere from a day to 6 months to a year or to 3 years. I would, if betting all of my money long term, it'd probably be a Uniswap as well. Is it pushing its valuation here when it's run up as much as it has over the last year to date? Maybe. But I think we continue to see DEXs grow significantly going forward.
Yeah, I don't have a good answer for this. It's definitely a tough question because there's so much exciting things happening in the space. I think within any one of these categories, you're going to have multi-billion, maybe even 50 or $100 billion protocols, and so it's definitely DEXs are a big opportunity, and I don't have an answer for this. I think because there's just too much exciting things happening. It's a cop-out answer, but
very diplomatic. I love it.
I wish I could have said that, but cool.
And then one final question before I give the reins to PG. So all of you guys work for really, really prominent firms, and there was one question here in the Q&A session for recent graduates that are kind of looking for a job within the VC hedge fund space in crypto. How do you get in touch with your firms? Is Polychain, is Arca, is a Delphi hiring?
I'll go ahead and start, and I can give a little background to what I did. So I bought the top in 2017, decided I hated losing money in this space and wanted to get smart on it. So pretty much since then, just continued to read. And what got me noticed was starting to write a little bit on the space. I didn't necessarily reach out to Jeff, our CIO at Arca. He ended up reaching out to me after I wrote an article on Medium, and we had the conversation about a potential internship over last summer. But yeah, I mean, Arca is currently hiring for research analysts, so feel free to reach out to me on that, and I can get you in touch with the right people. But yeah, in terms of getting a job in the space, just keep learning about it and know your shit about it. So yeah.
Yeah. So I got my opportunity pretty similarly. I DM'd my boss, or I DM'd Neil saying, hey, I really want to get into the crypto space. Is there opportunities? He said originally no, but come in and he'll show me around. 2 months later, or a few weeks later, he comes and say, we actually might need an intern for a summer. And then they finally offered me a full-time position. But we are definitely hiring. Delphi's hiring. So if you want, you can go on our site and check that out. And I would say what separates you is just, I think, just it's not your background, it's just how much you know, right? So if you really push yourself to learn and stay up to date on this stuff, because it's hard, I think that'll show.
Yeah, definitely. I think one of the coolest parts about the crypto space is that the space is so young and most of the people in it are so young that there's like the experience gap is far less than what you would see in literally any other industry. And so like for context on Polychain, I'm 24. One of the partners at our firm, Niraj, who drives like a ton of deal flow, he's 24. We have an intern who started the summer after he graduated high school. And like all of this is just to show that like there is a whole spectrum of like age or experience means nothing. It's purely based on like how much you know about crypto and how dedicated you are to understanding and thinking critically about the space. Anybody with any background of any age can come in and add value, even at a firm like Polychain. And so, yeah, I think if, my kind of background was just, I was interested in crypto and I just sort of like dropped everything else I was doing for a year and was kind of like researching effectively full-time. I did like a part-time internship, unpaid one summer for a crypto fund out of Houston. And then that helped me get an internship at Autonomous Partners, a different fund. And then that ultimately helped me get to Polychain. And so it was just sort of like stepping stones, but all of that was rooted in just endless reading of white papers and, deep diving into everything I could find in the crypto space. And yeah, I think Polychain, like all these other funds here, is also hiring, for just about anything. If anybody's interested, feel free to reach out or just interested in chatting. Happy to talk.
Just so that everybody is familiar with who these guys are. So Alex got a job offer by writing really, really cool stuff on pair trading and did statistical analysis on it. Paul won like a ton of money through the block tower competition, which is crazy. And Jacob literally worked for Ariana Simpson's, who is one of the first fund managers in the space and now works for Andreessen Horowitz. So these guys are really incredible, and they all kind of did this by just going down the rabbit hole. Yeah, now I guess on to you, PG.
Going to the rabbit hole, and it's pretty deep. But I want to wrap this up by thanking everybody here, Alex, Jacob, Paul, Robert. Thank you so much for being here. It's kind of late there, and also for, it's 20 minutes overtime, so thank you double. There's a networking portion if you want to stick around and meet the audience. Otherwise, I know it's late, feel free to go. But again, we run this every week. Next week, we're running an event with the Ethereum Enterprise Alliance to talk about how zero knowledge can be used for business and enterprise. It's going to be pretty cool. So check it out. Follow us on Twitter and LinkedIn and all the other media that we have. Other than that, thank you so much. Robert, thank you for being an amazing moderator and also for asking that job question. I know a lot of the students out there really want to get into the space, but we keep hearing this. The best way is you got to get into that rabbit hole. Get on Twitter, get on Medium, read those articles, read those white papers. That's the best knowledge you can get. And always try to think on, by yourself and like form your own idea. I think that's very important, especially in crypto, where there's a lot of scam. So other than that, thank you again, guys, for being with us. We'll now transition to networking. Thank you so much.